So the interesting thing in after hours, by the way, isn't, to me anyway, isn't that Meta is up tagging 497 area, which is elevated, right? There's about 504 is strong resistance. It's having a hard time getting above that. It's that the 10-year yield has dumped further.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
And the yield just across the board, that 2-year that I keep showing, if we break 4.2, it's really going to come down with or without. And that's the strange part about this, right? Where are we at this cycle where the 2-year breaks that 4.2 and Fed is just still sitting on the sidelines? What does that say about where we're headed with yields clearly giving a path lower, 5, 7, 10, 30? It's been great for my warm summer housing market call where the 30-year would fall, move would fall, the 10-year would fall, and then lots of potential, mortgage refinancing, nothing like 2020 or 2008, 2009, but just the fact that it would create more of that cash request, a demand in refinancing that may or may not be used for more equity buys. But the big picture is this is still falling quite strongly, regardless of what Yellen is doing, regardless of what Powell is saying. Thoughts on this whole complex rolling over hard now? Where are we at?
Look, I think there's a trade-off, right? Basically for equities. And if, it's multiples and earning expectations and, kind of drive where equity prices go. And multiples are often driven, by the moving yields, right? And so there's a dynamic in play where as yields fall, multiples expand. There's bonds versus stocks reason, there's Fed model reason. And so you can get that kind of multiple expansion when yields fall. The question is, why are yields falling? And are they indicative of some economic reality that is going to be worse for the earnings growth outlook? In which case, that multiple expansion, you got what you got out of multiple expansion. Now earnings are going to start to get hit because the economy is slowing, and so there's no more reason to buy equities. Now, something like housing. Right, ITB has made a high or very close to the high, I forget, because of this move in rates.
Mm-hmm.
But mortgage activity is still garbage, right? There has been no refinancing wave yet.
No, they're already pricing in the potential.
No, right. So this market has front run the front run, and I think that's been in part because of rotations and unwinds and out of tech into somewhere else, right? So, the market is stretching these relationships well beyond what the economic realities. And so the question is, really, what are the economic realities? Are we going into a more protracted slowdown between here and the end of the year and into next year? Or, as some people think, this move lower in rates has put a floor in economic growth. And if we have, 2.5% inflation and 2.5% growth, we're at 5% nominal, and that's, the economy is going to be fine. And I think that the jury is out on that. I know which way that I'm betting. I'm betting that the bond market is getting concerned because growth is rolling over, but it's not clear yet. And so, I think ITB and housing has benefited from that multiple expansion from rates moving down, but it has done very, the move in the real economy has really not reacted to the fall in yield.
That's one of the reasons why I look at the refi rate, because 90% of mortgages are under 5%. If we do have a refi wave, it's not because they want to refinance at a higher rate, it's because they need the money.
Right. So I don't think we're going to get that refi into risk. I think people who are refining are basically saying, shit, I have a good mortgage. My house is worth 40, 50% more than what I paid for it.
Yeah.
I kind of need to tap that. I'm willing to.
That's why I watch it. That's why I'm really on this since March.
Yeah.
This is what I see coming. But I also see, these earnings, we could have, 2 more quarters before we really hit a wall next year. So it's just one of those things that I'm watching. It's early, but it has worked. That 30-year, the 10-year, the move index, they're all falling. And with that, mortgage rates are going to trigger some refinance, not a huge wave, but it's very telling who will refinance. Are they doing it to get a lower rate?
Yeah, no, it's people are trying to pull some of that value out of their home because they need the money to pay bills.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.